Howdy there, folks. Welcome into the buy one, get one free here today. Two videos for me to react to. First one up here is from last night. It's about a 4-minute clip I want to react to. U.S. recession is delayed, not canceled, Thornburg said. So I want to hear what this gentleman has to say, kind of give my opinions and perspectives. And then we got this beast to react to here, this almost 8-minute clip here from the professor, Jeremy Siegel. The professor says, no way bonds are as good as stocks for long-run wealth creation. So obviously he's going to share his perspective on a whole lot more than just that subject, but I thought that would be an interesting video to react to here today. So appreciate everybody joining me as always. Thanks so much for being here, folks. New all-time high subscribers in the history of the channel. I think we're 33,800 plus now, I believe. So we're approaching 34,000 subscribers. So appreciate y'all being here. Glad you enjoy the channel, and let's get into this.
I'm sure you're watching this very closely. Are you concerned about contagion risk, and do you consider China to be investable right now?
We are concerned about contagion risk, and really I think what we're having to adapt to is a new world where we can no longer count on China being the counter-cyclical force to some of the more developed markets. Right? Earlier in the show you talked about fighting a slowdown with just additional debt, and that's what we've been doing here for the last over a decade and a half. And now it's really starting to come to bear. The consumer can't support that increased debt stock. Governments around the world can't support that increased debt stock. And we are worried about that contagion because China is slowing, but it's slowing along with the entirety of the rest of the world on the back of higher rates and just that constant pulling forward of demand.
So we've seen the government take a few measures to try and stabilize this situation, but is it enough, and what more needs to be done in your view?
Yeah, right now it isn't enough, and I think the most interesting part to be watching as many of those Chinese officials come back from their secret retreat to see what they do roll out. But China's in a tough spot because one of the traditional measures would be that it weakens its currency. But of course, on the back of trying to insert it into one of the large global reserve currencies of the world, I think China will be reluctant to significantly continue weakening its currency. So we'll have to watch and wait, but I really don't think there's much they can do, and I don't think there's much a lot of governments around the world can do. We're simply having to pay for all of that.
All right, I'm taking this party inside because apparently I got a go-kart track behind my house or something. I don't know what's going on here. Already, the party can resume.
Pull forward of demand that we've had on the back of low rates and easy fiscal and monetary policies.
Jeff, you manage two huge global bond funds, and China Inc. is obviously issuing a lot less bonds, a lot less fixed income in the universe these days.
See, what this gentleman is kind of talking about here, this is why it's very important for the Fed to lower rates rather soon. Because let me ask you a question. If, let's say, we have a big recession, let's say unemployment climbs substantially, what do you think the reaction is going to be from the government, from the Federal Reserve? Print, baby, print, okay? And we're going to see debt levels go to much higher levels than they're at now. They'll make today's levels look like a joke. So that's why it's very important that if the Fed actually wants to bring down debt levels, if the government actually wants to bring down debt levels, it's very important they don't kill the economy. Because if you do that, you will end up having to raise debt massively more. You will end up in another printing cycle again. You will end up in one of those situations, right? It's just how it works. There's no situation where, like, the economy gets devastated and the government doesn't do anything because they're politicians. They all get voted out of office if that happens, right? People rebel, like all those sorts of things, right? So they're forced into that situation. The Federal Reserve would be forced into that situation. There's no like, oh, what would they do? No. Rates would go to zero again. Print, baby, print. Same exact thing. Quantitative easing, all that crap, okay? So that's why it's like, they go too far. Not a lot of people understand, like, if they go too far, it's just going to end up in a worse situation down the road. So that's why it's very important they don't completely destroy stuff.
Would you be interested in China fixed income at all, or are you concerned there might be a crisis in the waiting?
I think it's less about a crisis from the bond perspective, but it would be a little bit more of a crisis from the currency perspective. As I mentioned, I don't expect to see China significantly weaken its currency, but it's something that as global bond investors, we would have to watch very carefully. Now, of course, on the back of that, China used to be the country with notably higher rates relative to the rest of the world, and that just simply isn't true today. It's relatively easy to get 4%, 5%, or even 6% in many global markets in very high quality bonds. So for us as global bond investors today, we're focusing on safety and playing not so much in China, but more the U.S. and parts of the Eurozone.
So explain to us how you could see, returns disappear from the government bond market universe, because that's literally what happened in the last month. And many, not just yourselves, but many houses are doubling down on this idea that there is a recession coming and that this is not the wrong trade. Explain that to us.
I mean, we've been saying for quite some time, the recession is delayed, it's not canceled. As we watch all of the incoming economic data, and if we were to rewind the clock, thus far, the recession is playing out almost exactly as we would expect, with the consumer slowing, right? We see sentiment broadly deteriorating. We see loan conditions tightening. Now, it hasn't led to that precipice, that cliff of an outright recession. So it is delayed, but it's happening in lockstep to what we would expect.
Yeah, I don't know if I agree with that, because if you look at, he brings up a few things, right? Consumer weakening, consumer sentiment, those sorts of things, right? Consumer sentiment actually bottomed at the lowest level we've ever seen in the history of the Michigan Consumer Confidence Index last summer 2022. Okay, so it's been over a year. And since then, consumer confidence has increased. It has gotten better when it comes to consumer sentiment, okay? Secondly, there's a phenomenon going on right now that we haven't seen in like over 2 years, and it just started transpiring very recently in the last few months. Real wages have finally got to a good place. Okay, we have not seen real wages at a good place in like 2.5, 3 years, and they finally have flipped over to a positive place now at this point in time. Basically meaning people's wage increases or whatever they're making is outstripping on a year-over-year basis versus CPI. It's very positive, okay? So that's not things you usually see going into a recession. You don't usually see sentiment improving and real wages actually improving. So that's where we get into this very confusing market, very confusing. And this is why it's a very dangerous market to be all in the market, all out of the market, or all against the market, because there's so many different factors here at play that are just like, this is not the normal signs you see before a recession, just factually. Because you look at many previous recessions, usually consumer sentiment is weakening substantially prior to the recession. And actually, we have consumer sentiment now getting in a better place. So this is a very confusing situation. Real wages now starting to actually get in a good place for the first time in years. That's a confusing matter. And so, yeah, we're in quite a time, folks, quite a time.
It has been a surprise on the back of all of this to see government bond yields continue to rise. But I think we've been talking about this for quite some time. The world is expecting an immediate pivot once we see weakness, and we're just not going to get it this time around, because we're emerging from a very low inflationary environment back to the more normal state of the world, which is a sustained higher inflationary environment.
So we do have a situation where rates are elevated. You can get a really good return on cash. So why take risk? What's your cash allocation right now?
Our cash allocation is a little bit higher today, but one of the things that we're telling investors is now is the time to lock in safety. So yes, 5.5% money market funds are tremendously interesting, but we have to remind ourselves, it's relatively easy to get that 6 or even 7% yield in high quality fixed income. And it's that part of the portfolio that will actually go up if we do get that recession. So what we're telling investors is to move into high quality fixed income today and leave a little bit of cash for being more opportunistic in some areas of equities if and when we do get that recession.
Yeah, so, let me answer a question before we get into the Professor Jeremy Siegel. Because obviously right now you can get between about 4 to 4.5% from a savings account right now, right? You can get from a treasury a little over 5% if you're in something shorter term, like under 2 years, pretty much. I think even the 2 year might be yielding around 5% right now, right? So the question is, a CD account, you might be able to get like 5% if it's a locked in CD. So the question is, should you chase maybe the 5%, but your money's more locked in, or just go after like a savings account where maybe it's a little less money you make? My opinion is it's better to actually go the route of a savings account right now, because you can get that capital tomorrow. There's no penalties with that or any of that stuff that you're dealing with when you're kind of locking in your money in a CD or treasuries or something like that, right? So that's kind of my opinion, is savings accounts the better route to go, because, you never know what can happen in the market. All of a sudden, you could get a major crash that happens in a 60-day, 90-day period, and you want to be able to take advantage of that, right? And so you don't really want to deal with a situation where your money's locked up, or all your interest is basically, you don't get that interest if you pull your money out, or at least something like that. Rather than just keeping a savings account, you're getting your interest consistently, right? And then, boom, something happens in the market, you need that money, boom, you can go ahead and deploy that. So that's my personal opinion. Make a little less to have access to your capital this second. That's my opinion, okay? All right, next one up here, the Professor Jeremy Siegel. Let's hear what he has to say.
University of Pennsylvania's Wharton School. Good morning, Professor.
Good morning, Steve.
Okay, so let's start off with where the economy is now. And Jeremy, you have an idea here about what's going on with productivity that's, I don't know, I don't think people are thinking enough about this. We've had a couple lousy quarters, and then we had a couple really good quarters. Do you think we're really having a productivity surge in this economy?
It's Jeremy, not Jeremy. I hate that, man. Kids in school all the time. Jeremy. It's Jeremy, okay? Get the name right.
Well, yeah, I mean, the last quarter was, outside of the few months around the pandemic, the best quarter for productivity in over 6 years. And if this quarter, I mean, we've been, I know the St. Louis Fed is way up there. Others are not that high. But, given modest growth in hours and in payroll, it looks like another third quarter boom in productivity. This is really saving Jay Powell. I mean, this is the best news. I mean, that's how you can have strong GDP growth without pressure on the labor market. And
I mean, all these things, you can look at them positive or negative. We can look at it and say, oh, this is saving Jay Powell because the economy is holding up. Is it really? Because you could make an argument that it's potentially making his job harder. If you just went into a recession, you start seeing job loss and things like that, and inflation completely collapsed, obviously to 2% or under, then the Fed's job is done at that point in time, right? But if you have a really strong economy, and let's say you get another spike in inflation at the end of this year, let's say in 2024, then the Fed has to say, I think we need to go even higher on rates, right? Which puts even a bigger risk. The higher Fed funds rate goes, and for the longer period of time, the more risk it has to the overall financial markets.
Without pressure on inflation. That's the golden magic over here. So I think that's really playing into what we see in the economy. And by the way, why yields are going up also, real GDP growth and real yields. I'd like to comment. You guys had a great discussion right at 6 o'clock when you opened about real returns and the tips going to 2%. Is that a way that you should now invest in for wealth? Let me mention 2% a year. It's good. It's the biggest in decades. However, 2% after inflation a year takes 36 years to double your money. At a 20 PE, which you also mentioned, which is right, that's a 5% earnings yield in stocks, the general S&P 500. That takes 14 years to double your money. So,
okay, all right.
By the time you double your money in bonds, you've multiplied your money by 5 times in stocks. So people who tell me, oh my goodness, bonds are as good as stocks, no way for long run wealth creation.
Let's unpack that.
100%. I mean, you can break it down much more simple than that. What he just discussed there, that's really more high-level stuff that if you're more an experienced investor, you get it. But let me just break it down very simply. Think about it this way, okay? I want the very best businessmen and women in the world running businesses for me that are going to generate a whole lot more money in the future. Because those people are the creme de la creme. They're going to get you great results over time, right? Not every single one of them, but many of them will get you great results over time. And I can obviously take part in that huge profit that they're going to be making over the coming years, right? I'd much rather put my money there and bet on those individuals because they're going to figure out how to make money in any sort of environment, recessionary environments, expanding economy environments, right? Anything, inflation, deflation, all this stuff, they're going to figure out the best path forward. These are the best of the best, and they're going to figure it out, and they're going to get the job done. And I'd much rather bet on those folks to do it than anything else, just to be quite frank, than commodity or than bonds or anything.
Because I think that's important, and it's kind of against my thinking on this, right? Which
you'd like to like bonds, but you can't.
I really want to like bonds.
You can't make that case.
I'm going to try.
Nobody has ever built wealth.
Professor, you're telling me I can see this 5 juicy % 2-year note and I put my money in there, at the end of that period, I'm going to get 5%. And that's going to be 3 percentage points or 2 percentage points higher than the inflation rate. And I'm going to be really happy. You're telling me I'm going to be unhappy because I was better off putting my money in stocks. I should ignore those big, fantastic yields on the 2-year.
First of all, in 2 years, anything can happen. we know that. I mean, the stock market could go down 10 or 20%. I'm talking about building longer term wealth. And I'm saying if particularly if you're young, you're building a retirement account, you're thinking about, your retirement, that's what really counts. And 2% is certainly attractive compared to earlier. By the way, when TIPS came out in 1997, they were 3.5 and they went above 4. So, I mean, even though 2 is certainly better than it was 10 years ago, 5 years ago, and so on, it isn't all that great compared to history and well below stocks. The average over 200 years is 6.5, and I'm giving a conservative 5% after inflation rate of return in stocks. You are absolutely right. In 2 years, you might be very happy with bonds. You might not be happy with bonds. But over 10 years and 30 years, you're not going to be happy with bonds.
If rates go down, you have nowhere to go. You're stuck with your stupid 5%. And then, if rates go up, I guess you can reinvest a little and then you can get 6%. But if you don't want to buy NVIDIA and make, whatever, or the Magnificent Seven or something really sexy, you can buy really good companies that have a yield of like 2 or 3%, and they raise their dividend every year for 15%. So suddenly the dividend is up to your 5% in a couple of years, and you got the capital. It's just unless you need a stable part of your portfolio that you're going to get a return on. But and if it's not corporate, if it's not.
Hey, what is this? 2 people on vacation. Where's Becky Quick? And where's the other dude? Ross Sorkin.
Then you even got to worry about getting your money back anyway if you go out to eat.
And then you got the reinvestment problem. Professor, can you handicap this weekend?
So you believe that? You don't. That was a devil's.
I know.
You were just trying.
I am putting a portion into the 2-year. I am buying.
You are?
Well, with the cash that I have, I
if you put 10 grand in, and I told Kelly this last week, you get 4. This is on a longer term, but 4. It went from 4 to 4.25. That means, you know what that means on 10 grand? If you take your wife out, you can get an appetizer after a year, right?
Everybody.
Well put. Well freaking put.
Likes an appetizer.
Yeah, because instead of $400 that you get on 10 grand, you get $425. It's just like, come on. This is a stock market channel.
That doesn't mean people should only invest in stocks.
No, but it kind of does.
Professor, can you just handicap this week and what you think Powell should say, what he will say? Where's policy going, and what does that mean for the stock market?
Very, very honestly, Steve, and of course you follow the Fed so closely. Since the 3.5 weeks, I guess it is, since the last press conference, I don't think a lot has happened that changes the outlook. I think he's going to say, we're not, quite done. We're close to the job. I think he's going to stay very data dependent. Don't forget, we still have a full month with a load of data announcements coming out before the September 20th meeting. So he's going to stress that data dependency. I think there will be a kind of a slightly hawkish tilt because, we're not down to that target. But, honestly, I don't, if you want to know the truth, the higher real yields and the higher interest rates are working in his direction towards tightening policy without raising.
I want to cut you off on that real quick.
Rate.
But here's the thing. If he follows what you talked about at the very beginning of this conversation, that productivity is higher, that we can have stronger growth, lower inflation, and a low unemployment rate, would you tell him that he should not be hiking anymore and that maybe he should think about cutting?
I would be on the alert, but I would say, you don't need to hike anymore. You got tightening on that long end since the last meeting. And when we take a look at all the other indicators, the break even between the TIPS and the 10-year, which is one of their favorite indicators of what 10-year inflation is going to be, it's 2.3%. Okay, that's not 2.0, but my goodness, that's take a look at what the market is looking at longer term and seeing those trends. I don't think that's threatening. And you want to start, listen, the term structure is uninverting. Do you want to invert it more? Yes, you will if you raise another 25 basis points.
Who's coming in? It's a go!
Professor, it's always a pleasure to talk to you.
On the Fed funds, yeah.
Professor, always a pleasure to talk to you. Thanks for joining us this morning.
Thank you very much, Steve.
Bet money, that was a dog. Bet money, that was a dog that opened that door. Bet money, okay? So, here's the problem. So Jerome Powell obviously could look at things kind of the way, and by the way, I'm in the camp that I don't think the Fed should raise anymore. I've been in that camp for several months now at this point in time. So I don't think they should raise anymore. But the pushback to that from Jerome Powell's perspective, right, and the Federal Reserve's perspective is we just had CPI go up actually on a month-over-month basis, right? We have a stock market that looks pretty dang good right now, right? We have an employment market that's still 3%-ish unemployment, and it seems like it's still one of those economies, if you need a job, you can get a job. Doesn't necessarily mean you can get the greatest job ever, but there's plenty of jobs out there. It's not one of those economies where it's like, geez, man, can I even get a job at Taco Bell? Like, holy smokes, man, it's so tough out here. Certainly not one of those markets right now. So you have that. You have a fear of, let's call it reinflation again. And what happens if we went back up to a CPI 4% or 5% number? What would happen? Then the Fed has to come back in again, raise rates even higher. So that's a fear from the Federal Reserve. So you gotta look at it, with the shoe on the feet both ways, in my opinion. The problem is a lot of people only want to look at one way or another. I think you need to look at it both ways in the situation. So, in my opinion, the Fed can just keep interest rates here for a bit, see how things play out here for a little bit, and then make a judgment from there. Do you want to start cutting in 24? Do you want to continue to raise rates? I think the only argument for raising rates more is if you really saw a CPI starting to fly again. And next thing you know, we're at 4%, 4.5%. Then, damn it, you got to come back in with the hammer and say, you know what, we're raising rates again. That would obviously be pretty traumatic for the market to go through. Let's put it that way, okay? Appreciate y'all joining me as always. Thanks so much for being here, folks. Thanks for being subscribed. New all-time high subscribers in the history of the channel. If you want to apply to join my private group, check out the pinned comment down there. You can fill out an application. We see if you're a good fit to join there. Learn everything I have learned over the past 15 years being part of that, plus get to join with these 6- and 7-figure members. Much love and have a great day.